Picture this. You wake up tomorrow morning, check your trading account, and see a number that makes your heart skip a beat. Not because you lost money, but because you finally cracked the code that separates the 5% of profitable traders from everyone else. What if I told you that code has nothing to do with finding the perfect indicator or mastering complex chart patterns? What if the secret weapon hiding in plain sight is something you carry with you every single day but have never learned to wield properly? Today we're diving deep into the psychological triggers that either make or break every single trade you place. These aren't feel-good motivational concepts. These are battle-tested mental frameworks that can transform how you think about risk, reward, and every decision you make when real money is on the line. By the end of this video, you'll understand why most traders fail not because they lack technical knowledge, but because they're fighting an invisible enemy that lives between their ears. Let me start with a story that perfectly illustrates what we're dealing with. Imagine watching 50,000 different people trade over an entire decade. Imagine seeing patterns emerge not in price charts, but in human behavior. That's exactly the unique perspective that revealed something shocking about this game we call trading. After observing literally hundreds of millions of trades, one thing became crystal clear. The vast majority of people make identical mistakes over and over again, and very few are capable of making money consistently. This observation led to a profound realization. Trading success has absolutely nothing to do with technical analysis or fundamental analysis. Sure, those skills matter, but they're not the determining factor between profit and loss. The real battle happens in a much more subtle arena, and most traders don't even realize they're fighting it. Think about the last time you took a loss. Not just any loss, but one of those trades where you knew exactly what you should do, yet found yourself completely unable to execute the right decision. Maybe you watched a position move against you, telling yourself you'd cut the loss at a certain point, only to freeze when that moment arrived. Or perhaps you rode a winning trade up, planning to take profits at a specific target, but got greedy and watched those gains evaporate. These scenarios happen because we're dealing with psychological forces that operate at a much deeper level than conscious decision-making. When money is at risk, especially significant amounts relative to our personal financial situation, our brains activate ancient survival mechanisms that served our ancestors well but can be catastrophic in modern trading environments. Consider what happens physiologically when you're in a losing trade. Your amygdala, the brain's alarm system, starts firing signals throughout your nervous system. Stress hormones flood your bloodstream. Your heart rate increases. Your thinking becomes narrow and reactive rather than broad and strategic. In this state, you're literally incapable of making optimal decisions, no matter how much technical knowledge you possess. The most successful traders aren't those who never experience fear. They're the ones who have developed a fundamentally different relationship with these psychological states. They've learned to recognize when emotions are driving their decision-making and have built systematic approaches to maintain objectivity even when significant money is at stake. One of the most dangerous psychological traps in trading is the need to be right. This need runs so deep in human psychology that many traders would rather lose money than admit they made a poor decision. Think about how backwards this is. The entire purpose of trading is to make money, yet ego protection often takes priority over profit protection. This psychological quirk explains why so many traders struggle with cutting losses quickly. Taking a loss feels like admitting failure, like broadcasting to the world that you made a mistake. But in reality, small losses are simply the cost of doing business in a probabilistic environment. They're not failures any more than paying rent is a failure for a business owner. Professional traders understand that their edge comes not from being right all the time, but from managing their reactions to being wrong. They've accepted that trading is fundamentally a game of probabilities, not predictions. This acceptance allows them to take losses mechanically, without the emotional drama that destroys most retail accounts. Let's talk about another psychological phenomenon that wreaks havoc on trading performance: pattern recognition gone wrong. The human brain is incredibly sophisticated at identifying patterns, but it often sees patterns where none actually exist. This tendency, known as apophenia, causes traders to find meaningful signals in random market noise. You might look at a chart and see what appears to be a clear support level that has held multiple times. Your brain interprets this as a reliable pattern, leading you to place trades based on the assumption that this level will hold again. But markets are dynamic systems influenced by countless variables that change constantly. What worked yesterday might not work today, and what appears to be a pattern might simply be a statistical coincidence. This doesn't mean technical analysis is useless, but it does mean you need to approach it with the right psychological framework. Instead of looking for certainty in an uncertain environment, successful traders use technical tools as probability assessments. They might say a particular setup has a 60% chance of working based on historical data, but they're prepared for the 40% of times when it doesn't. The concept of confirmation bias adds another layer of complexity to this challenge. Once you've identified what you believe is a trading opportunity, your brain automatically filters information to support that belief while ignoring contradictory evidence. You might notice every bullish signal on a chart while completely overlooking bearish indicators, or vice versa. This selective attention happens unconsciously and affects even experienced professionals. The key is building awareness of this tendency and developing systematic approaches that force you to consider alternative scenarios. Some traders create deliberate devil's advocate exercises where they actively look for reasons why their trade idea might be wrong before placing any position. Risk management represents perhaps the most critical intersection between psychology and trading success. Most traders approach risk management as a purely mechanical exercise, calculating position sizes and stop-loss levels based on mathematical formulas. But effective risk management requires emotional sophistication that goes far beyond simple calculations. The psychological challenge of risk management becomes apparent when you consider how most people relate to money. For many traders, especially those starting with smaller accounts, each trade represents a meaningful percentage of their total capital. This creates a psychological pressure that makes objective decision-making nearly impossible. When you're risking money that you can't afford to lose, every price movement triggers emotional responses that cloud your judgment. Fear of loss becomes so intense that you either avoid taking trades altogether or exit profitable positions prematurely to lock in any available gain. Conversely, when losses occur, the fear of realizing those losses can prevent you from cutting positions when you should. Professional traders solve this problem by only risking capital they can afford to lose without affecting their lifestyle or emotional well-being. This isn't just practical advice, it's a psychological necessity. When the money at risk doesn't threaten your financial security, you can make decisions based on probability and strategy rather than fear and greed. But capital allocation is just one aspect of psychological risk management. Time management represents another critical factor that most traders overlook. Spending hours watching every price movement creates an emotional attachment to positions that interferes with objective decision-making. The more time you spend monitoring a trade, the harder it becomes to cut losses or take profits mechanically. Many successful traders deliberately limit their market exposure to prevent this psychological contamination. They might check positions only at specific times each day, or they might use automated systems to execute exits at predetermined levels. The goal is to maintain emotional distance from individual trades while staying focused on long-term statistical outcomes. The psychology of winning creates its own set of challenges that are often more destructive than the psychology of losing. When trades go your way, especially when they generate substantial profits, your brain releases dopamine and other reward chemicals that can be literally addictive. This biochemical response can lead to overconfidence and increased risk-taking that eventually destroys the gains you've accumulated. Many traders experience their largest losses immediately after their biggest wins. Success breeds complacency, and complacency leads to poor decision-making. You might start risking larger amounts because previous trades worked out well, or you might abandon the disciplined approach that generated the profits in the first place. The most psychologically sophisticated traders maintain the same emotional state whether they're winning or losing. They understand that both outcomes are temporary and that their long-term success depends on consistent execution rather than trying to maximize any individual trade. This requires developing what psychologists call emotional regulation skills. Emotional regulation in trading means maintaining a stable psychological state regardless of recent performance. When you're winning, you stay humble and focused on process rather than outcomes. When you're losing, you remain confident in your approach while staying open to necessary adjustments. This balanced mindset allows you to make optimal decisions based on current market conditions rather than recent trading results. Developing this emotional stability requires practice and often involves working on psychological patterns that extend far beyond trading. Many successful traders invest significant time and resources in personal development, meditation, therapy, or other practices that enhance their self-awareness and emotional control. The role of expectations in trading psychology cannot be overstated. Most new traders approach the markets with completely unrealistic expectations about potential returns and the consistency of those returns. Social media and marketing from various trading education companies often promote the idea that substantial profits are not only possible but probable for anyone willing to learn a few simple techniques. These unrealistic expectations create psychological pressure that makes rational decision-making impossible. When you expect to make 50% returns annually, every losing trade feels like a personal failure rather than a normal part of the statistical process. This pressure leads to overtrading, revenge trading, and other destructive behaviors that guarantee poor outcomes. Professional traders typically expect to be wrong more often than they're right. They focus on generating positive returns over extended periods rather than trying to profit from every individual trade. This mindset shift removes the emotional pressure from individual decisions and allows them to execute their strategies consistently regardless of short-term results. The concept of randomness poses another significant psychological challenge for traders. Markets often move in ways that appear completely random, at least in the short term. Human beings are naturally uncomfortable with randomness and tend to search for explanations even when none exist. This discomfort with uncertainty leads many traders to overtrade or constantly adjust their strategies in search of the perfect system that eliminates randomness entirely. But randomness is an inherent feature of market behavior, not a problem to be solved. Successful traders learn to operate effectively within uncertain environments rather than trying to eliminate uncertainty completely. Accepting randomness doesn't mean abandoning strategy or analysis. Instead, it means understanding that even the best strategies will produce losing trades and losing periods that have nothing to do with the quality of your approach. This understanding allows you to maintain confidence in proven methods during inevitable drawdown periods. The psychological impact of drawdowns represents one of the most challenging aspects of trading psychology. Every systematic approach experiences periods where performance deteriorates, sometimes for weeks or months at a time. During these periods, it's natural to question whether your strategy still works or whether you need to make significant changes. Most traders abandon profitable strategies during temporary drawdown periods, often right before those strategies return to profitability. This pattern happens because drawdowns trigger deep psychological discomfort that makes rational thinking difficult. The key to surviving drawdowns lies in understanding that they're a normal part of any trading approach and preparing for them psychologically before they occur. Successful traders often maintain detailed records not just of their trades, but of their psychological states during different market conditions. They know how they typically react to winning streaks, losing streaks, and various types of market volatility. This self-awareness allows them to recognize when emotions might be influencing their decision-making and to implement specific strategies for maintaining objectivity. The social aspects of trading psychology also play a crucial role in long-term success. Trading can be an isolating activity, and the lack of immediate feedback from peers or supervisors can make it difficult to maintain perspective during challenging periods. Many traders benefit from connecting with other serious traders who understand the psychological challenges involved. However, it's important to be selective about trading communities and social influences. Much of the trading-related content on social media focuses on short-term results and promotes unrealistic expectations about potential returns. Engaging with this type of content can reinforce psychological patterns that undermine long-term success. The most valuable trading communities focus on process improvement, psychological development, and realistic expectations about market behavior. Members share insights about managing emotions, maintaining discipline, and developing the mental frameworks necessary for consistent performance. These communities provide support during difficult periods without promoting unrealistic optimism about easy profits. Technology offers both opportunities and challenges for managing trading psychology. Automated trading systems can help remove emotional decision-making from trade execution, but they also require psychological discipline to implement and maintain properly. Many traders struggle with the temptation to override their systems during drawdown periods or to constantly adjust parameters based on recent performance. The key to using technology effectively in trading lies in understanding its role as a tool for implementing systematic approaches, not as a replacement for psychological development. Even fully automated systems require human oversight, and that oversight must be guided by sound psychological principles. Mental preparation represents another critical aspect of trading psychology that most traders overlook entirely. Just as athletes prepare mentally before important competitions, successful traders develop routines that put them in optimal psychological states before making trading decisions. This preparation might involve meditation, visualization exercises, reviewing trading plans, or simply taking time to clear your mind of distractions from other areas of life. The specific techniques matter less than developing consistent routines that help you approach the markets with clarity and objectivity. Physical health also plays a crucial role in trading psychology. Poor sleep, inadequate nutrition, and lack of exercise all impair cognitive function and emotional regulation. Many professional traders maintain strict health routines not just for general well-being, but specifically to optimize their decision-making capacity during market hours. The relationship between stress and decision-making becomes particularly important for traders who manage substantial positions. High levels of stress impair the prefrontal cortex, the brain region responsible for strategic thinking and impulse control. This impairment makes it much more likely that you'll make decisions based on immediate emotional reactions rather than long-term strategic considerations. Understanding market cycles and their psychological impacts can also improve your ability to maintain objectivity during different market environments. Bull markets tend to promote overconfidence and risk-taking, while bear markets often trigger excessive conservatism and missed opportunities. Recognizing these psychological tendencies allows you to adjust your approach accordingly. The most successful traders develop what psychologists call metacognitive awareness. This means not just thinking about markets, but thinking about how you think about markets. They monitor their own psychological states and decision-making processes, constantly looking for biases or emotional reactions that might interfere with optimal performance. This level of self-awareness requires ongoing effort and often involves working with coaches, therapists, or other professionals who specialize in performance psychology. Many successful traders view investment in psychological development as just as important as investment in market education or trading technology. The journey towards psychological mastery in trading is ongoing and never truly complete. Markets evolve constantly, and new psychological challenges emerge as your account size grows and your circumstances change. The key is maintaining a commitment to continuous improvement and staying open to feedback about your psychological patterns and their impact on your trading results. As we wrap up this exploration of trading psychology, remember that these concepts require practical application to become valuable. Reading about psychological principles is just the beginning. The real work involves implementing specific practices and systems that help you maintain objectivity and emotional control when real money is at stake. Start by identifying your own psychological patterns and triggers. Keep detailed records of not just your trades, but your emotional states and thought processes during different market conditions. Look for recurring themes and develop specific strategies for managing your most challenging psychological tendencies. Remember that psychological development in trading is not about eliminating emotions entirely. Emotions provide valuable information about market conditions and your own decision-making processes. The goal is learning to use emotional information wisely rather than being controlled by emotional reactions. The 5% of traders who achieve consistent profitability aren't necessarily smarter or more technically skilled than everyone else. They've simply developed the psychological frameworks necessary to operate effectively in probabilistic environments where uncertainty is the only certainty. With dedicated effort and the right approach, you can develop these same psychological skills and join their ranks.